Okay, in our second lecture here, we're going to talk about transportation economics. We talked about in the first lecture, we talked about world economics and applied that to what transportation is all about. So we're going to talk about the transportation side of this now. And then in the third lecture, we're going to talk about infrastructure or transportation asset management. So here we go. All right, you know this, we've talked about this before, so I'm just going to refresh you real quick. I mean, the significance of transportation, freight transportation, is it allows us to do things like this. And this then allows us to be competitive, particularly in like commodity markets, as we spoke about in the previous lecture. And you know that transportation is driven by demand and supply. You know that it bridges that gap and that it is pretty much focused. I mean, really, we focus on mass production here versus customization, though that's kind of a trend that's changing. And you also know that transportation in and of itself is a component of landed cost. So the lower the transportation factor is in production and the landed cost, or including the tariffs and the duties, which we saw can vary dramatically depending upon the market that and even the country that you're shipping to, does play a significant part in where goods are sourced. So again, transportation is a significant contributor to everything that happens within the economy here today. You're going to see some numbers here that reinforce the facts that transportation is the largest factor in logistics costs, and arguably the most complex because of the number of decisions we have to make regarding it. So as you know we've talked about this, transportation is the place utility factor in the marketing mix. So the marketing mix is product, price, promotion, and place. And transportation provides the place. And we discussed this in the 3770 class that when you look at the interlocking supply chain concept and you look at the gears and you look at how everything emanates out of the demand forecast as finally agreed upon by all the participants in that process, that everything is held together by transportation. And so if none of that works in and of itself if the transportation side does not execute in accordance with the plan, and that's not a given. And we're going to talk about that and why it's not a given, and why there are certain things that we have to focus on as transportation management to ensure that gets done. And that is not necessarily tactical. It's not a matter of scheduling a truck into the dock. That's one of the things but that gets to be very strategic and very collaborative in point of fact in terms of its execution. The actual delivery of the truck is the tactic, but the setting the strategy that is an important part of our metrics is strategic in nature and requires partnership. So again, we talk about right product, right place, right time, and right quantity. And there's other things, as you know, we've spoken about right information, right condition, things like that. But all this kind of plays together if you look at it. The service components needs to get there in good condition. It has to come at the right time. It has to be that needs to be reliable, and we need to have accessibility in terms of where that level of service is. This matrix in and of itself requires flexibility in today's transportation management world that we're having. This is not a set box that you climb in and it just happens by itself. This is a very eclectic set of components that varies market by market, customer by customer, day by day, shipment by shipment. And that's the challenge of this. So we've already established previously that it's demand driven. You see this right here. This is the economic growth cycle in blue, and in red is what we call the transportation services index, which is basically transportation costs as it relates to over the same period, as it relates to demand. So this is called the TSI, or the Transportation Services Index, and it's issued by the Bureau of Transportation Statistics. So it's a key indicator. In fact, it's a leading indicator, which we'll talk about. So when you look at TSI, you see how this tracks very carefully. So therefore, things like consumer sentiment, as we spoke about before, is an extremely important thing. Do you feel like spending money? Are you comfortable in spending money right now for whatever purpose you want to do it? Or are you feeling stressed out over it? Because if you are, then you're not going to spend. If you're not going to spend, then we need less and less transportation. So we've also talked about elasticity. We know the previous slide showed that the TSI, that is the overall Transportation Services Index, follows demand. But what that says is that transportation in and of itself is really elastic. What's inelastic is the actual carrier you use. And so, I'm sorry, is it the way around? Yeah, demand is inelastic. That's right. Didn't sound right as I heard it. So the absolute demand is inelastic. So we know that transportation is required based upon the changes in demand. So that's inelastic. What is elastic is the carriers and the modes themselves. And there's more elasticity in the carrier you choose than in the mode, but because of some of the changes that the transportation companies are making, plus the new business models that third-party companies are coming up with, you're looking at not making necessarily you're looking at perhaps a little less elasticity, as we're using different business models to attack this. So for example, a third-party provider will give you access to the entire range of modes, and you're not necessarily tied down to the carrier making that carrier decision. So that's what they can do for you. And we've also talked about inventory to sales ratios. This is the latest number. This is for 2016. And we know that, again, here's the TSI freight. We see that this is you can see the direction of it. So as inventories went up, transportation went down. That's the trend line you would expect to see. And as inventories start to rebuild, transportation starts to rebuild. So again, reinforcing the same concept that's out there. We're looking at moving more and more goods. There shouldn't be any question about that. We're looking at, in the next 20 years or so, we're looking at virtually doubling the amount of product that we're going to be moving in terms of value, and not doubling in terms of weight, but certainly in terms of value. So this is what we're kind of planning against, and this is what we hope our transportation policy is looking at and saying, well, wait a minute, if we're going to move more and more by truck, which is what this is suggesting, because the populations are migrating into the cities. So we're really looking at not megacities in the classic sense of what we have in what is typically considered to be a megacity, which is like populations of 20 million or more, or 10 million or more. But we are looking at more migration into the city because that's where the jobs are. And while in some countries that's being forced on the population, in the United States, it is being encouraged that people who are not employed, who have the skills, move to where the jobs are, because the jobs may not reach them because of where they are. And as I said in the last section, that can change based upon the transportation network. Society's growth and expansion, as migration and everything is a function of transportation. So we now have 20% of the population is literally outside of metropolitan areas, and those jobs are simply moving into the metropolitan area because that's where the demand is, that's where the infrastructure is, and that's where the information systems are. So, and the skills are. So that's what's driving all that. And it's not dissimilar to what we're seeing in other parts of the world either. So the rest of this presentation, we talked, yeah, I showed you the 2016 report for CSCMP, and I have shown you that and discussed that and brought this into the class. Now we have the 2017 report, and so the rest of the next 10 slides are basically saying on this, and I'll put this in your reading file for you, and we'll take a look at it there. But this is again logistics, so it's not supply chain. So that we're talking here about the logistics, business logistics costs, of which that's where transportation resides. So let's take a look at what they kind of say. So what we're seeing here is for the first time, we're seeing that there was a decline in U.S. business logistics costs since 2009. So that's the recession, of course, was the height of the recession was 2009, and it has been relatively level up until this last year, and then there was a slight drop. It's only 34 basis points, but there was a slight drop in 2016. So what we're seeing here, and we've talked about this, and you will talk about this as we go through this class, is the impact of overcapacity. So that is, as demand slowed down, as trade slowed down, as demand slowed down, the carriers themselves were not able to respond to it at the rate at which that slowed. So we have overcapacity. Overcapacity puts rate pressure, and that's what we saw. So we saw transportation rates in total moved down slightly, even though the parcel component of that and the small shipment component of that went up 10%. So, which is reflective of the e-commerce market that is we all talk about. The other thing that's affected it is subpar GDP growth. So our GDP growth declined year over year, and so therefore this would decline as well. And we've hit this so many times. I hate to hit it again, but this is still continues to be a drag on the economy. The overall uncertainty, all the conflicting signals that are out there. GDP growth in Q1 was 1.2. They actually, I believe, revised that down a little bit, but Q2 I think was a little higher, but not dramatically, but still below where they thought it was going to be. And even with all this, in the transportation world we live in, this hasn't slowed down the pace of change. If you think about what you read about autonomous vehicles and flying cars and drones and fuel alternatives and mergers and acquisitions and technology changes, none of that has slowed down. Some of the technology changes that were on the table for some such thing due to regulation has slowed down. But the key one, which is the electronic logging device, is still in place. So from a safety standpoint, I mean, some of these technology issues were being forced on the market. A couple of things have kind of slowed down, like the sleep apnea tests. They decided not to regulate that, but decided it's in the hands of the firms, which means that the firms are liable if they don't do it. They don't need a regulation to do it. They need to know they need to do it. They're not saying don't do it. They're saying you shouldn't have to be regulated to do it. So some of those costs have come out, but certainly the technology change has not abated at all. And in fact, we're using more and more advanced tools in everything that we're doing in this industry, and we'll talk about that when we talk about technology. So here's the latest version of this. Even though energy costs went up slightly, spending fell. So you can see this right here, where, and I'm looking over here to my left because I can see it there. So that's a 0.7%. That's a 7% 0.7% decline in transportation spend, but you can see the transportation spend is 900 billion out of 1.4 trillion. So this again just confirms the importance of transportation in everything that we're doing. And if you look at the year over year, you see some of the impacts on overcapacity right here. And anywhere you're seeing a CAGR that's in a positive standpoint and it is above 2 points, then you're seeing price pressure on this particular mode. That would be over 2 points. So if you look here, motor carriers, we're looking at 4.3% 5-year CAGR being compound average growth. Full truckload, though, on the other hand, is up here at 4.3, so that's good. But who's losing? Less than truckload, okay? Because it's going to parcel. So these are the kinds of mode. This is where we're looking at mode shift within the modes. But as you know, the mode shift has different metrics related to cost and service. So that's what we're looking at. Cost of capital came down. You see that right there. It has come down dramatically, and it's come down overall, and is still expected to come down even more. At the same time, that warehousing space has increased, and it truly has, and that's primarily because of the network expansions by the e-commerce guys, particularly Amazon, who have done so much in rebuilding their networks. They've taken up millions of square feet, and of course, are now a third-party logistics player. And then this is admin, which kind of reflects, not much change, but I think you'll start to see more change down here as you see more automation of some of the more routine things in the future. So here's the trend line that we spoke about. And you can see here's 2009 right here. You can see where it dropped and it came back up. It's been relatively level and just a small decrease here. What we also see here is that rising interest rates, there is a relationship between interest rates and the cost of doing business. So as you look at the rising rate, if this continues and you have there's no more demand, demand does not increase to match that, then somewhere the costs have to come out of this. And the question is where do you do that? And obviously, transportation is an area that you can make an impact at a micro level, but the bigger impact is going to be more automation and fewer people in the pipeline. And this will not necessarily bring intermediate goods back into the domestic market if this continues in this pace. Right now, we're not sure because the Fed's expectations is the actual numbers are below what the Fed expectation was. So there's a real possibility that this won't occur, but the trend line is still factual and applicable. So now let's look at sentiment. Okay, I think all of us every day we wake up to saying, okay, now what, now what, now what? And that's of course sentiment. So there's a Michigan study, there's a variety of studies that goes out. I think you can see here, there was a huge sentiment push in terms of tax reform, in terms of infrastructure, which of course was jobs. Tax reform puts money in our pockets. There was going to be something done on the health side. None of which is materialized. And so the question is, you can start to see the sentiment is starting to decline, and the level of that decline then gets back to the demand side, right? And we have we're close to what we call this natural employment rate of 4.3% to 4.7%, which would suggest that we are at full employment, where we had the discussion. I don't disagree with that. I don't agree with that. That's the historical number we've always used, but I think we're not at full employment. But we have this structural issue that's out there. So there's still more opportunity to gain more productivity if we can if we can improve the structural unemployment situation. So you gain GDP by producing more with fewer people. That's with more people. So that's how GDP rises, right? So if we don't put anybody else back to work, there's very few people left to go back to work if you accept the natural rate. So productivity cannot go up, GDP cannot go up unless we automate and more. And that can have other repercussions as a result of that. But right now, we're in this very steady growth pattern of 2 points. It's very solid, so that's good. Yeah, but we're not really going to break out of that. Okay, so this is the business logistics cost, and this is the inventory number, and you can see we've talked about numbers like when business inventories, when the inventory sales ratio reaches like 1.45, we start to see inventories come down. So this is what you saw right here. Inventories are starting to come down, and the ratio now is starting to come down. And this shows better understanding of demand. So this is again potentially a reflection on the fact we're doing better job of demand forecasting. And so this would not be unexpected if we do a better job of this. So as things have kind of leveled out here, which is what you're seeing here in terms of inventory, and we're seeing a little growth, you're seeing this drop right here. So that makes sense, okay? So, but as a result of this, companies have to pay attention to this all the time. You have to continuously monitor this. That's one of the points we made and when we talked about sales and order processing and the fact that this needs to be a very routine, scheduled event that everybody has to participate in. And so as inventories kind of go up and down, freight goes up and down. And that's what this shows you right here. So the fluctuations in tonnage is all around the fluctuations in inventory and personal consumption. So it's all about demand. Now, there is some modal shift here as we move to e-commerce, but these things are intricately tied together. And so we can predict and see what the future looks like based upon historical data, barring some major black swan like North Korea that knocks this whole thing out. So here is world trade. World trade, which we spoke about, is expected to increase faster than this based upon what Carney is saying here. It was very low last year, just 1.3%, which is primarily based on most of the world. Well, the US grew at like 1.2 or something like that. But the rest of the world was even worse. So we're starting to see, as you saw in the first lecture, you're starting to see some of that kind of recover. And so that'd be good. So I would think that hopefully we'll see in the next report, we'll see this line kind of go up that way. But I think, again, yeah, it's the uncertainty. I mean, the sentiment index showed you that when the new administration came in, there was an expectation that things that had not gotten done were going to get done, and that has not been the case so far. And whether they prioritized them in the right sequence or not is arguable. We'll all have our take on that. But I think if what I would call the business side of this, for example, lowering the corporate tax rate, it will be a tremendous job starter from an administrative standpoint. So that you're not talking there about the skills you're talking about there are a little different. You're talking about skills in the manufacturing floor. But I think could create another movement up, and that's not only because of the jobs themselves as companies potentially look at relocating here, but what we call the multiplier effect, which is those folks have to eat, they have to buy houses, they have to do this, they have to do that. And that's called, of course, the multiplier effect, and that's where the jobs kind of show up for all skill levels. So that was an important one in my mind, and they haven't gotten there yet. So What is all this telling us? It's telling us this. We're looking at mixed signals. It's going to continue. There's no indication that that's going to change as of now. But that there's just no indication that much is going to get done from the campaign promise standpoint. The gap between the campaign promises and the government policy is enormous right now. We do know that transportation expenditures are an important part of the GDP. We just showed that is almost $1 billion of GDP. I'm sorry, $1 trillion of GDP out of 24. So that's not insignificant as an activity. In order to address the U6 rate, it's transportation that makes that happen because it's the geographic and the labor specialization that occurs through transportation that allows us to start to attack that structural unemployment number that we have. And just to reiterate this, and we'll come back to this, is that that transportation drives urbanization. It drove urbanization throughout the entire history of this country, and it continues to do so. And so the more that we can connect some of these more rural areas through transportation, urbanization will move out. I mean, we had a classic case around here. Look at what's happening in O'Fallon. Yeah, O'Fallon is in essence a business center in and of itself at the fringe of the MSA. So, people can live in Wentzville and Warrenton and work in O'Fallon because it's not that far away. So they don't have to go downtown. They don't have to go to our city. It moved out there because of the transportation network that we have. So that's pretty much kind of where we are right now. So we're going to stop with this one right now and come back. We're going to talk about the infrastructure issue that's out there. Back in a minute.